What's up, everybody? Michael Silva here. You're watching the Stock Market Brief Show. In today's video, we are going to be looking into many divergences that are building within the market, which are throwing up red flags. Could be nothing, but it also could be something. We're also going to be getting into these shorter time charts. We're going to go over expected moves, give you some ideas as what to expect going into this next trading session. If you're new here, welcome to the channel. This is the Stock Market Brief Show. We use technical analysis and intermarket analysis to get a good idea as to where the market might be headed next. Go ahead and hit that thumbs up. It is greatly appreciated. Let's get into it. All right, so we're going to go ahead and start off with really kind of peeking behind the curtain, right? So today, it was a decent day. We finished in the green, but it wasn't a great day to start with. It was overall a very weird day, to say the least. It was choppy, and then we got this squeeze up higher, getting us into the green. I want to call out here something interesting, and that is the VIX. When I take a look at the VIX has now just reached another new closing low for 2023, and a new low that we haven't seen since, well, really the start of 2022, which was the start of the bear market. And when we make a close right at around 1695, we'll call it 17, we can pull up this chart over here and look at the number 17 for the VIX, come all the way down to the right-hand side over here, and you can see this typically correlates to around a 1% slightly higher move, and this is plus or minus. That's what you can expect on a daily basis with the S&P 500. So as the VIX value obviously goes lower, if it goes lower, it means that these days that we start to move up could be, smaller and smaller and smaller, right? And that's typically what happens in bull markets. But let's just pump the brakes a little bit. Just because the VIX is going low doesn't necessarily mean that, hey, we're in this new bull market. Let's take a look at skew. Skew has been moving like a rocket ship to the upside, and now it's almost above 135 right now. And what this is just telling us that, hey, there is hedging taking place in the overall market, right? Buying puts, selling calls. Take a look at the TNX, the 10-year yield. This was also took off like a rocket ship today, up 1.96%. We had a bullish crossover on the PMO. And one thing to note is on rapid rates of change to the upside, that's not typically good for growth stocks. And mind you, we are moving into the earnings season for some big growth names. Now, as the yields go up, bonds obviously come down, and you can see TLT is now coming back from hitting this prior area of resistance. You can see all the moving averages are starting to coil up here, get very tight, and now we're kind of testing the lower portion of this. So in my opinion, I think that, right around this 103.50, if you are looking to accumulate bonds and you think that we're moving into stage one of the business cycle, that means where bonds are something that goes up, stocks and commodities typically go down. Doesn't mean all stocks go down, but stocks and commodities typically go down. This would mean that this could be a good potential area to just get some in. Maybe we can buy some more lower. It all depends. As I'm looking at this kind of looks like an ascending triangle, right? You see a low, a higher low, a higher low, a higher low, and it's currently a higher low as it stands right now. So the bulls are currently stair-stepping themselves up, getting these moving averages from very bearish trend to more of a neutral trend. So it's something to continue to watch out for. I also am paying attention, obviously, to the Fed Watch tool. Now we're pumping in a 91% probability. So after today's trading day, there is now a 91% probability that the market's pricing in that we will be getting a 25 basis point hike in the May meeting, which is just around the corner, right? So there's a lot of catalysts taking place. Not only earnings as the VIX is coming down, we have skew going up, we have the probabilities of a rate hike increasing, and we have obviously earnings season as well. And then the debt ceiling debate too, that's going to be coming around the corner too. So a lot of things are just building while it feels like, right, that it hasn't been more bullish, ever, right? If you just take a look online, it's a new bull market. Hey, it might be. Maybe they're right. Tomorrow, macro data. What do we got? Building permits. Most of this stuff is coming out 1 hour before the market opens. Then we're going to have Bowman come out a little bit after the market opens. And then we have some API crude oil stocks change. I don't know if these are going to necessarily move the market right over here or these, but we will find out come an hour before the trading market opens. And then keep obviously an eye on this speech over here, because sometimes that can say one thing and then the market just takes it negatively. Now we also have earnings pre-market. So not only the macro data drop, we also have these are the names in the S&P 100 that are reporting pre-market. So we have big names, right? We have Goldman Sachs, Bank of America, J&J. All these are big names because they're in the S&P 100. I want to first go over to Bookmap and just give you these expected moves to watch out for. Bookmap is very awesome software. If you trade from a candlestick chart and you're trading intraday, what you don't see, unless if you're looking at it, is level 2 data, which is market depth. It's like taking the blindfold off where you can see orders hanging out. Now, unfortunately, level 2 data, if you're not really good at reading the tape, it moves very, very quickly. So you have to literally just be on, and it moves just very fast, very quickly. Here with Bookmap, you can see large orders that are hiding out, and you could literally track those and see them potentially move up as price goes up, or you can see them break down through those certain areas or those big orders, and it gives good ideas of where, hey, I can potentially put a stop down here, or I can put a potential short position up into another area, etc. So this is some amazing software. I'm not going to walk too much through this at this point. I want to first call out a couple of interesting things that I'm seeing that are starting to take place after the market closed. So the market closed right here, right? We have futures open up, and we have some orders that are kind of opening up here. The 41.98, okay, 41.98 is the upper expected move for ES going into tomorrow's trading session, and that lines up pretty well right here with a big order that's been kind of sitting there for the day at 4,200. So that's that psychological level there. Above that is at 4,210. So this could be a very interesting level to see if price action could get up to here to see how it responds and reacts from that level. The lower expected move is 41.53. Now below that level is where we have another kind of big order sitting out, hanging out that opened up here after the market closed. So 41.45, and below that is 41.30. So if you do trade ES, or if you trade futures, or even if you don't, and it's always good to just check in on it because it's a very clear picture of the overall market, you can watch for those levels. So take a look at the daily chart on the SPY. As you can see, we kind of pressed up a little bit higher today. I included this rising wedge structure, right? We have a tag here, almost here, and right here, and then you can see we just expanded to the downside. Now what we're doing is coiling up tightly here. So either we can get a break from this 418.31, maybe get an overshoot. Remember, where we came from was way down here, and now we're all the way up here, and we talked about that on yesterday's video. But it does look like at some point we will need to consolidate or pull back. We will see the white line over here. If you're new here, this is just the year-to-date open for the SPY, and the one below that is day one of the SPY 2, and that happens to be the low for the year. So now we're coming up to test the high point of the year, which we're not too far off. If we get above 418.31, that means the SPY made a new high in 2023. Now let's take a look at the 15-minute time frame. So it was a choppy day today, right? We opened up right here. This is the 15-minute time frame, and it's just big range candles, chop, 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 chop. We broke down a little bit, but we tried to come back up, and then we had a flush, and then it was just a lot of chop. Now, this is kind of where I was looking for a potential break of this bear flag. But remember, just like we said in yesterday's video, we're above the 5-day moving average that's inclining, so the bull's still in control. So we broke down, we came back to backtest the 5-day moving average, and then we just got some ridiculously just strong move from that point, reclaiming the week-to-date daily anchored VWAP. So going into tomorrow's trading session, right? This is not something, once again, that I want to chase into because it's already a very strong move, unless if you're, intraday trading tactically. We have 416.38 to the upside, 411.50 to the downside. And even if we were to come all the way back down here, once again, right, we'd be above a 5-day moving average, right? We maybe watch the week to date because that could be something potentially to check or a test back to. And then the month to date is starting to turn up here too as well. So the bulls still remain in control at this moment. I do like to see how he broke through this level over here. So if we do get some sort of pullback, the RSI kind of resolves itself from being oversold conditions. Watch the week to date. And then if we start getting below that, then just pay attention to the 5-day moving average and then the daily expected move for the lower end if you're looking to be a little bit tactically play it from the long perspective or add into maybe a position. Just depends on your strategy. If we take a look at the Qs overall, what are we doing? We're doing absolutely nothing, right? So we're just literally just going sideways for a long time. This is since March 31st. Now it's April, we're going into April 18th. I will say that we have a high or a low. We have a higher low, a higher low, a higher low. So the bulls are making progress here. However, we have a high, we have a lower high, we have a lower high, we have a lower high. Okay, so right now as it stands, price action is coiling, right? It's coiling up, right? We had this explosive move. Now we're starting to consolidate. Okay, Well, I don't know if it's going to go down like that, but watch for a potential break. If we start breaking from that level, it does open the door to 322.53, which would be an amazing shot there. And then you want to see it. You want to see price hold these previous swing lows over here. So if we start breaking down to 315, the lower daily, there might be a back test of the 5-day moving average at some point where we start to flag up. Then you could potentially look to short into that if we get continued weakness, head down. That's kind of the strategies and the way that I'm picturing this. If I take a look at the dollar chart, the dollar started breaking out. So this is a little bit more of a divergence that we're talking about, kind of peeking behind the curtain here. The dollar started breaking out. If the dollar is going to start moving here, I feel like we're the S&P 500, it's going to struggle to move much further to the upside. And I can show you, that's not just really all just an opinion. I can show you the correlations between the S&P 500 and the US dollar, and I could look at it on multiple time frames. So we're looking at a 15-day correlation, 30-day, 90-day, 120, 180, and you can see the levels. I don't even need to show you there. Minus 0.61, so that's a negative correlation. Minus 0.6, negative correlation. Minus 0.48, minus 6.4, and minus 60. So what does this mean? It means that when the dollar goes up, it's likely to see the S&P 500 go down. When the dollar goes down, it's likely to see the S&P 500 go up. So what does that mean? It means if this is actually a move that we're going to be coming up and ripping up higher at a rapid rate of change, careful in the S&P 500. Okay, let's get into some more divergences. This is looking at the value line geometric index. Now, if you don't know what that is, don't worry. I'm going to just show the divergences. You can Google it just to get an idea. It's an equal weighted index, and it allows to see some divergences taking place. It is actually one that I was looking at way back here in going into 2022, and I'll show you what a negative divergence looks like here. The XVG was putting in a high and then a lower high. Okay, so the lower high right here was taking place while the S&P 500, the SPX, was moving to a higher high, right? So it shows us here that, hey, there is some subtle weakening taking place here, but the market's pressing higher, right? There's some few names driving the market higher, and that right there was a negative divergence. And what happened? Well, the market started to sell off. Well, the vice versa thing can happen here too, where the XVG puts in a higher low, but the market's putting in an undercut, right? It's putting in a lower low. That could tell us, hey, it might be a good time to actually buy the market and potentially play for a rally, because it's telling us the internals of the market are strengthening. What's going on right now? As it stands now, the XVG is underneath a declining 20-day moving average. We have basically a lower high right here, matching highs, and the S&P 500 is pressing higher. Now, this is a very close correlation between the two, so this can very well break out, and then it's negated, right? We don't need to worry about it. However, if it does start breaking out and the S&P 500 breaks through that 4,200 area, well, XVG has a long way to go to match that high. So there will still be a larger divergence taking place in this, which is a little bit of a warning sign, especially with all this stuff. Like I said, all the macro drops that are coming out, the Fed meeting, the earnings season, the debt ceiling. We got to be aware of this, okay? Now, if we take a look at these divergences building, this is known as Dow theory. This is the Dow Jones Composite Average. Okay, so the Dow Jones Composite Average, a lot of people say the Dow Jones, they're thinking the Dow Jones Industrials, right? Well, the Dow Jones Composite Average has industrials, has transports, has utilities, right? So it's all inclusive into the Dow Jones Composite Average. Now, the composite has been putting in a higher high, the industrials too. But if you look here and here, what we're starting to see is the transports aren't actually matching that. They are diverging from the industrials at this current moment. Now, the last time that this happened, we called out over here, and that was going into February. Now, the longer the divergence, the more important it is to pay attention to. So when it's a really short time frame, it's not too big of a deal, but we're coming into around about a month. So it's starting to throw out a little bit more of a warning sign here too as well. Now, utilities has a shorter divergence, right? We're not tracking it from right pre-April, but we are tracking it here where it didn't match that new high as you can see the industrials did, and obviously the composite. So transports is a huge piece. You can't have, industrials pump higher and higher, but yet transports can't match it and they're starting to go down. That is a a very important sign that the market is data the market is telling us some data that we need to pay very close attention to. Let's go into this chart. This chart is the NASDAQ 100 above us, and then we have the percent of stocks above the 50-day, percent of stocks above the 200-day moving average on the NASDAQ 100. Now, you can see right here, price is a high to a higher high. Okay, what is the percent of stocks above the 50-day moving average? So as the market's moving higher, why are stocks not following? Well, it's because very few stocks are helping the market move higher, which is not a great sign. Now, on the flip side to that, what happens if more stocks are helping the market should go higher, but the market is not going higher? Well, that's a positive divergence, which we saw here in October, right? As the October was reaching to a low point of an overextended area, this 10% level, right? So if just so you know in future reference, if this happens again, right, 10% of stocks above the 50-day moving average, that's a very, very low oversold condition. And you can see same thing here with the 200-day. And what happened? Well, the market started to bottom out here, and then we started to rally as the internals got stronger. So just like how the internals got stronger here, and that helped the market, well, the internals right now at this current moment are getting weaker, which could obviously impact the market. Okay. Now, take another look at the Nyeseem-McClellan oscillator. This is the NYMOT. This is a traditional calculation here of the Nyeseem-McClellan oscillator. And I wanted to just call out the broad market here, the New York Stock Exchange. It is clearly, we broke down from this rising wedge, right? And what did we have here that gave us warning signs? And go back to watch this video. I talked about it the entire time, right? The market was making higher highs, but the internals were saying, yeah, it's something's going on here. It's weakening here, which is a divergence, right? And that told us ahead of time about this drop. Well, it's starting to do it here too. Now, can this just be broken and come right back up and get a 300 reading and get overextended? Absolutely. But as it stands right now, it's not, right? We have a high, a higher high, we have a high and a lower high, which tells us there is a divergence. So that, my friends, is peeking behind the curtain and looking through the stealthy ascent of the stock market. Now, I want to go into the zones really quick. I just want to reiterate the VIX is at that low level. The low range here is at 1638, and we currently close at 1695. The 10-year yield, right, is getting pretty red hot right here, and we saw that monster move today, which is not typically good for heavy growth names, but yet the market still finished up. Financials is getting a little bit heated again, and this is also on the backs of some financial earnings that we previously shown. Here, if you want to screenshot this, these are the expected earnings moves, okay? For Goldman Sachs, Bank of America, J&J, BK, which I think is like Bank of New York, I can't remember, and then Lockheed Martin. Okay, so that's the main things. This is something that I share with my Discord group. I did make some changes to my Discord recently. I've now included daily expected moves. I didn't include that here on the Patreon, like the landing page, but if you want to join it, I don't post anything on Patreon. I post it all on Discord. So if you join on Patreon, you sync the Discord up, you get access to my channels. It's $9 a month. I do weekly expected moves. I track about 40 products, daily expected moves. And I'm going to show you some of the charts that were on the watch list, because in yesterday's video, I talked about there was a lot of good setups taking place. And we said, the basic principle of technical analysis, one of them is stocks move between expansion, right, and contraction. And then you want to be able to play the expansion move while you have very tight risk. Well, I'm going to give you some examples. So here is one of the charts here that I posted, right? IoT was one of them. It was basically you have a high, a high, a high. You have a low and a higher low and then a higher low. And price is just what? It expanded out to the upside and then it started coiling up, getting very tight. So if you play breakout, you have a very, very nominal risk or very well-defined amount of risk. Well, what happened today? We saw an explosive move of 7%. Here's another one, CAAP. And right, and this is, I'm just showing you examples, right? This doesn't happen all the time. Like you might look at this and be like, hey, I'll short it if it breaks down. Okay, that's a possibility. But these are all in bullish context above key averages. This was a pennant. You can see price action coiling up. So if it breaks out, you have a tight stop. You play the breakout and it moves up. This is a low volume stock, which I had to warn on. This thing moved 10% on a day. So you obviously have to update your risk parameters. You don't want a 10% move to become a loser all of a sudden. And then this one was just a monster too, C-Bay. And this thing, look how tight this was, right? So we have a low, higher low, higher low, higher low. And this thing was coiling up so tight, allowing for, if we break out of this level, out of the pivot, okay, you can have a very defined stop loss and you could play for a move out of that. And look at what took place, right? It was a 12% move on the day. This thing was a monster. Now remember, that's why it's so important to manage risk, because if you enter early, you can have a 12% move to the downside very, very quickly, right? So you have to have that well-defined risk. But if I look at this, you have a stop loss under this prior low while this breaks out. Well, you're only risking this much, and the thing moved all the way up here, which is obviously over a 1-for-1 trade. So those were some of the good trades that took place. That's kind of what I look for when I post the trade ideas. I don't give specific entries. I give sometimes like red and green boxes, but mainly I keep it, I want the trader to become better, right? So that's why I only charge $9 a month. I don't charge $200. I don't charge $1,000. I don't charge $70 a week. I charge $9 a month. That's it. That's all I got for you on today's episode, everybody. Hope it helped out. See you later.